This LOS is calculate and interpret the degree of operating leverage, the degree of financial leverage, and the degree of total leverage. Leverage. Leverage increases the volatility of a company's earnings and cash flows and increases the risk of lending to or owning a company. Additionally, the valuation of a company and its equity is affected by the degree of leverage. The greater a company's leverage, the greater its risk, and hence, the greater the discount rate that should be applied in its valuation. Further, highly leveraged or levered companies have a greater chance of incurring significant losses during downturns, thus accelerating conditions that lead to financial distress and bankruptcy. Companies that have more fixed costs relative to variable costs in their cost structures have greater variation in net income as revenues fluctuate and hence more risk. Just going to take a screenshot of the ebook and just show very quickly, not go through all the calculations, but the example, it's quite easy to understand from the example in the text. So when we're looking at leverage, they're considering the example of two companies. We've got Impulse Robotics here and Malvy Aerospace. So they're giving the contribution margin statement, revenues, operating costs, operating income, financing expense, net income, okay? And so you can see that we've got the same revenues and the same net income. Revenues is $1 million, net income of $200,000. But what the text goes on to show is that they say they have the same net income, but are they identical in terms of operating and financial characteristics? Well, no. We can see here that the operating costs are higher for Malvy Aerospace, so our operating income is different. And then here we have a much higher financing expense on Impulse than we do at Malvy Aerospace. Okay, so despite the fact that we have the same revenue and net income, we have different cost structures. So it says here that the risks associated with future earnings and cash flows are affected by the company's cost structure. The cost structure of a company is the mix of variable and fixed costs. Okay, variable costs fluctuate with the level of productions and sales. Some examples of variable costs are the cost of goods purchased for resale, costs of materials or supplies, shipping charges, delivery charges, wages for hourly employees, sales commissions, and sales or production bonuses. Fixed costs are expenses that are the same regardless of the production and sales of the company. These costs include depreciation, rent, interest on debt, insurance, and wages for salaried employees. So now, continue with this example, Impulse and Malvy, Impulse Robotics, Malvy Aerospace. We can see that, so in this example, considering the number of units produced and sold is the same, 100,000, the sales price per unit is the same, $10, but we can see our variable cost for Impulse is less, $2 per unit, and for Malvy, it's $6 per unit. And we can see that over here on Impulse, we have higher fixed operating expenses, $500,000 versus the $150,000, and fixed financing expense is higher, $100,000 versus the $50,000. Okay, so it says here the risks associated with these companies is different, although we saw they have the same net income. They have different operating and financing cost structures, resulting in different volatility of net income. So they give an example here. If the number of units produced is sold is different from the 100,000, the net income of the two companies starts to change. It diverges. If 50,000 units are produced, well, then you can, once you're given that cost structure, you can go through and say, well, if it's 50,000, then we know the selling price is going to be the same. But sales minus variable cost, contribution margin minus fixed cost gives us our operating income, minus fixed financing expense is going to give us our net income. You can just simply run the calculations now that we've got the data there. So what we can say is, what's our operating income and net income at 50,000 units? What's our operating income and net income at 200,000 units? And we can see how that at 100,000 units, our net income was the same, but as we start to change, it diverges. Okay. So the section in the text just finishes then with this example, looking at this chart where on the x-axis we have the number of units, and on the y-axis we have the net income. So we can see here that at the 100,000 units, we had the same net income between Impulse Robotics and Malvy Aerospace. But as we increase the number of units, because Impulse has a higher fixed cost structure, it's more leveraged, we can see that the net income increases more. However, as the number of units decrease, the losses are also greater. And that's the whole point with regards to the leverage. Operating risk, financial risk, and total leverage. If the degree of operating leverage at a given level of unit sales is 2, a 5% increase in unit sales from that level would be expected to result in a 2 times 5% equals 10% increase in operating income. Okay? So that's what degree of operating leverage is telling us and giving us. So I just wanted to show the formulas now. How do we calculate that too? Okay? So here I have the formulas for degree of operating leverage, for the degree of financial leverage, and for the degree of total leverage. So you can see here I have it in terms of letters, and that's the way they give the formulas in the text. I find that a little bit harder to memorize, and that's not the way that I would memorize it. So you can see moving to the right for the degree of operating leverage, it is sales minus total variable costs in the numerator, which is our contribution margin. And in the denominator, we've got sales minus total variable costs minus fixed costs gives us our operating income. And that's why I put that into bold and green, because I think that's the easier formula to understand for the degree of operating leverage, contribution margin divided by operating income. Okay, so you can see here just in letters, that's what it's doing, quantity times price minus variable cost. So that's sales minus total variable costs in the numerator. Denominator, quantity times price minus variable costs minus fixed costs. So that's what the letters are saying. I find it easier to understand it just in terms of the contribution margin income statement. Let's go through the contribution margin income statement again, just as a quick review. For those that don't have a stronger background in accounting, it's sales minus variable costs gives us our contribution margin, okay? Minus our fixed costs gives us our operating income. And then here they're using the nomenclature of C. Do you see this C? That's our fixed financing costs, and that's going to give us our net income, or what we sometimes say, the bottom line, okay? Sales top line, net income, the bottom line, okay? So you can see here with the degree of operating leverage, sales minus variable costs, contribution margin in the numerator, and in the denominator, sales minus variable costs, minus fixed costs is operating income. So it's easy to remember degree of operating leverage, I think, as contribution margin divided by the operating income, okay? That gives us our degree of operating leverage. Then if we move here to the degree of financial leverage, you can see the numerator is the operating income and the denominator is the net income. So it's operating income over net income. So now for the degree of financial leverage, we're looking at operating income in our numerator, net income in our denominator, okay? And then finally, for the degree of total leverage, we're looking at our contribution margin over our net income. So as I said, I think the easy way to remember this is just set up your contribution margin income statement and then remember what the numerator is and what the denominator is from that statement, and that's an easier way to calculate the question starting with that. So we can see the next thing that we move to, and that's why over here in terms of the percentages, this is important to understand. So we can see the degree of operating leverage is the percentage change in net income from the percentage change in the number of units sold. And so that's what I showed you, kept the example here from the previous slide, and that's what it's all about. Saying if we've calculated the degree of operating leverage is 2, then a 5% increase in unit sales, given that a 5% percentage change in the number of units sold, what's the impact on the percentage change in operating income? So for financial leverage, we're saying, given a percentage change in operating income, what's the percentage change in our net income? And for degree of total leverage, it's given a percentage change in the number of units sold, what is the impact in our percentage change on the net income, okay? So this is why I wrote down here, these questions can be typically set up as 2 steps. First, you have to work out the math, given the dollars given to you, sales units, contribution margin, fixed costs, fixed financing costs. You have to work out that leverage multiplier. That's what that 2 is. That's a leverage multiplier, okay? And then you have to say, then the question is, if the percentage change is X, then what is the percentage change in the net income or the operating income? So they work out to be two-step questions. One, calculate the leverage multiplier, and then two, apply that multiplier to, given a percentage change in the denominator, what's the change in the numerator, okay? So the next thing to understand is that if we look this formula here, the degree of operating leverage times the degree of financial leverage equals the degree of total leverage, okay? And you can see I've just taken the formulas from above. Degree of operating leverage, percentage change operating income divided by the percentage change number of units sold, times the degree of financial leverage, percentage change net income divided by the percentage change in operating income, equals degree of total leverage, which is the percentage change in net income over the percentage change in the number of units sold. Because you can see here, I just crossed out the numerator and I crossed out the denominator from the operating leverage and the financial leverage, and it showed you. And the same thing here, so I put it the left side, I also put it on the right side, contribution margin over operating income times operating income over net income equals contribution margin over net income. So that's important to understand as well, okay? So a quick practice question to check our understanding. Degree of operating leverage is best described as a measure of the sensitivity of A, net earnings to change in sales, B, fixed operating costs to changes in variable costs, or C, operating earnings to changes in the number of units produced and sold. That question should have been fairly easy. C is correct. The degree of operating leverage is the elasticity of operating earnings with respect to the number of units produced and sold. As an elasticity, the degree of operating leverage measures the sensitivity of operating earnings to a change in the number of units produced and sold. So you can see I've just reprinted the formula there. The degree of operating leverage equals the percentage change of operating income in the numerator, and then in the denominator, it's the percentage change of number of units sold. Okay, fairly easy one. That question is just asking basically what the formula is for the degree of operating leverage. Okay, this slide is just a little note that I wanted to point out that Schweitzer is a little bit different than the CFA Institute reading. If you go to the CFA Institute reading, the formula is exactly as I've given. But in the Schweitzer notes, they're using EBIT and EPS as well. So they've got the degree of operating leverage as the percentage change in EBIT over the percentage change in sales. The degree of financial leverage, they're using the percentage change in the earnings per share divided by the percentage change in EBIT. And the degree of total leverage, the percentage change in EPS over the percentage change in sales. So the degree of operating leverage is still, you recall, the degree of operating leverage times the degree of financial leverage equals the degree of total leverage. So we cross out the numerator and denominator, and we can see that the total leverage is the percentage change in EPS divided by the percentage change in sales, okay? So that's one area that I've seen has created a little bit of confusion before, is that the Schweitzer is using the EPS in the numerator, percentage change in sales, where the text is looking at the percentage change in net income versus the number of units, okay? So as you may know, I've taught CFA for a number of years. Of course, I've used the Schweitzer materials and used them myself to pass the tests back in 2001, 2002, and 2003. So this is I brought this slide up. Just you need to be careful a little bit. This is one of the issues of maybe relying only on prep provider materials. It's okay for level 1, doesn't work for level 2, but things may be a little bit different presented in the prep provider than they are in the text. And you want to make sure that if the question is given exactly as in the text, that you've seen it before. Gets back to my point that you always need to go back and review the official curriculum. The reviewer notes are always just a guide to help you get through it, but you need to go back and review what's in there. Sometimes there's some little differences, and this is a perfect example of a slight difference, and that could cause you some real confusion. You get into the test and you're seeing percentage change in net income, and you had memorized it as earnings per share, okay? So I took the example from the book and I just put it into Excel. So I do have an Excel sheet for this that could or should be made available. And I think this, and I just want to show this is kind of an easier way to understand this for people that don't have a strong background in accounting. So here they were giving us the data that the number of units produced was 1 million, and they give us the sales price per unit, the variable cost, the fixed operating expense, and the fixed financing costs, okay? So here you can see on the left-hand side, I'm just running at a million units. I do my contribution margin income statement. Sales minus variable cost, contribution margin minus fixed costs gives me my EBIT, which is in the book, or operating income, and that's why I said we need to be careful with regards to sometimes just the nomenclature. You know, Schweitzer might use EBIT, the book uses operating income. Just be careful there. Minus fixed financing costs, of course, is going to give us our net income. All right, so that's how we ran the numbers. That's easy to do. It's just a calculation. Okay, 1 million times 108 gives us 108 million. 1 million times 72, 72 million. 108 minus 72, 36. Minus the fixed operating cost doesn't change, and the fixed financing expense wouldn't change as well. Okay, so as I said, an easy way to understand, I've got my multipliers on the left-hand side, and then I have the what if. What if sales increase by 10%? Okay, so you can see the percentage change here, 10%. What if sales change by 10%? Well, if sales units increase by 10%, then our revenue would increase to 118,800,000 yen. But let's get back to that in a minute. Let's just finish here with the multipliers. You can see I mentioned that the way that I like to memorize it is just from the contribution margin income statement, that the degree of operating leverage is the contribution margin over the operating income, okay? And the degree of financial leverage is the operating income over the net income, and then the degree of total leverage is the contribution margin over the net income. So if you can kind of remember the contribution margin income statement and think of your multipliers in this way, I think that's the easiest way to understand it. And then when they give you a question, sometimes it's easy, even within the 90 seconds or a little bit more, to run out your contribution margin income statement and then calculate your multipliers in this way, okay? So then moving over here to the right-hand side, you can see if the units increased by 10%, then I'll just bring up my calculator. So we started with 1 million units, so 1 million, and we're going to increase by 10%, so I'm going to multiply by 1.1, so my number of units would be 1.1 million. And then here, I'm just going to rerun the contribution margin income statement at 1.1 million units. So multiply by the selling price, 108 yen, and that's how I've got the 118,800,000, okay? Then 1.1 million units times by the 72 variable cost, and I've got variable cost of 79,200,000. 118,800,000 minus 79,200,000 gives us our new contribution margin contribution margin, okay? Minus our fixed costs, 22,500,000 yen, doesn't change, gives us our EBIT, or operating income, minus our fixed financing charge, which doesn't change, gives us our net income. So then you can see here that our, when we calculated our contribution margin over the operating income, we got 2.67 as the multiplier. When we calculated the operating income over net income, we had the degree of financial leverage as 3, and operating leverage times financial leverage gives us our total leverage. 2.67 times 3 equals 8, correct? Just bring up the calculator. 2.67 times by 3, that gives us 8, a little bit of rounding, okay? So that gives us our 8. So you can see then from this example, if sales increased by 10%, then our change in our EBIT, our operating income, because the multiplier is 2.67, is 26.7%, okay? So let's just bring up the calculator and show it to you. And as I said, I think sometimes by running through this example, you really get to see what's happening here. You had your original contribution margin income statement at 1 million units. You increased by 10%. Just rerun the contribution margin income statement and then look at the change, okay? Then it becomes a lot less confusing, these formulas for operating leverage, financial leverage, total leverage, We're just talking about what the impact is to the contribution margin income statement based on the structure, based on the fixed costs and the fixed financing costs. So you can see here our operating income, when we increased sales by 10% in terms of units, it became 17 million. And that's easy to calculate, by the way, the contribution margin income statement. 17,100,000 divided by our original 13,500,000. Okay. And we're just going to minus 1 and multiply by 100. And you can see we're at 26.667%, which is 10% change in units times the 2.67 multiplier. How did I get that 2.67 multiplier? Contribution margin over operating income. Okay, so I think this little example again shows you how A, you calculate the multipliers, then B, what if sales increases by 10%, what is the percentage change in my operating income, what is the percentage change in my net income. So you can see with regards to the net income, we'll just finish this off properly. We have new net income of 8 million, which is easy to calculate. 8,100,000 divided by my original net income, 4,500,000. And that's going to give us, 1.8 minus the 1 times 100. And you can see that's our 80%. Okay. So our net income went up 80% if our sales increased by, sales units increased by 10%. So a nice little example, put into Excel. Just run the contribution margin income statement at the original level, run it at the if sales increases by 10% units, then look at the percentage changes in terms of your operating income and your net income, and you've got it. A, calculate the multipliers, and then compare it to your percentage changes. It all starts to make sense. So we're just going to finish this LOS with a practice question, as we often do. The Fulcrum Company produces decorative swivel platforms for home televisions. If Fulcrum produces 40 million units, it estimates that it can sell them for $100 each. Variable production costs are $65 per unit, and fixed production costs are $1.05 billion. Which of the following statements is most accurate? Holding all else constant, the Fulcrum Company would A, generate positive operating income if unit sales were 25 million. B, have less operating leverage if fixed production costs were 10% greater than 1.05 billion. Or C, generate 20% more operating income if unit sales were 5% greater than 40 million. I like this question because it can be a little bit confusing unless you've started to practice a little bit, but I think you'll see from the way that I set up the solution to this by setting up a contribution margin income statement, solving these types of problems actually are fairly easy, okay? But the question is giving us quite a bit of data, and then here A, B, and C's, they're percentages and numbers, units and dollars. It can be a little bit confusing, but let's go through it. B is obviously wrong because if you have more fixed production costs, you're going to have more leverage. So I could strike that one, and then the question is between A and C. Now C is asking about generating 20% more operating income if unit sales were 5% greater. So that's talking about the degree of operating leverage. So the percentage is the percentage change in operating income based on a percentage of number of units sold. So we have to calculate the multiplier for the degree of operating leverage. So as I said, the way that I like to do it is just to use the data that's given to me and set up a very quick contribution margin income statement. Sales minus variable costs, contribution margin minus fixed costs, which they've given us, gives us our EBIT, our operating income, minus fixed financing costs gives us our net income. But here we're just asking for the degree of operating leverage, so we only have to go down as far as the operating income. So I'm going to bring up my calculator very quickly, and I'm going to do 40 million units, okay, times by my $100 each, which is easy, and I'm going to have sales of 4 billion, okay? And then in terms of my variable cost, it says $65 times by my 40 million units, 40, okay? And I'm going to have fixed variable costs of 2.6 million. So sales minus variable costs gives us our contribution margin. So I can just hit the plus minus key, and then I'm going to do my 4 billion. I just got to be careful with the number of zeros. 4, and then it's 1, 2, 3, 1, 2, 3, 1, 2, 3. Okay, I've got my 4 billion, and I'm going to have my contribution margin of 1.4 million. And then the fixed costs are giving us 1.05 billion. I just have to be careful when I subtract that, again, with my zeros, 1, 0, 5, 0, and then 6 more zeros, 1, 2, 3, 1, 2, 3, okay? And I've got my operating income of 350 million. So we remember then our degree of operating leverage is our contribution margin divided by our operating income. So clear the calculator very quickly. 1, 4, 1, 2, 1, 2, 3, 1, 2, 3, divided by our 350 million, 350, 2, 3, 1, 2, 3. And that is going to give us a degree of operating leverage multiplier of 4. So you can see once we've got that, degree of operating leverage multiplier 4, if the unit sales were to increase 5%, 4 times 5 equals 20. C is the correct answer. So a nice little question. I know that took me longer than 90 minutes to explain, but I think the key to that, set up your contribution margin income statement, just crank out the numbers, and then you can answer any question. First get the multiplier, operating leverage or the financial leverage, total leverage. Once you got the multiplier, apply that to if unit sales were 5% greater, what is the impact then on either the percentage change in operating income, or for the total, it would be the percentage change in net income. Okay? And that's the last slide for this LOS. Thank you.